Okay, welcome to our K-State Research and Extension Virtual Grain Marketing and Outlook Strategies meeting. We are so glad that you are joining us today on this really sub-zero temperature weather that we're having. My phone, I believe, says a -2 right now. That's actual. And it feels like -17 below, but I'm sure all of you know that because I'm sure a lot of you are calving and you have been out all night checking calves, and you will continue to do that over the weekend. So I really do feel sorry for you. So hopefully you can bring the calves in, warm them up, and you can keep warm yourself. We're going to give it maybe another minute here while some other people jump on as well. But I am glad that you decided to join us. We decided to cancel our in-person grain marketing workshop, Winning the Game, that we had scheduled for Tuesday of this week in Belleville. We were just a little concerned and uncomfortable with everybody driving with the really cold temperatures. And now we have even colder temperatures. So we decided to go on, provide you some information so you can still have that. Hopefully you all got copies of Dan's presentation that you can take notes on as well. We will also be recording this session, and we will be posting this on the River Valley and the Post Rock District website. So sounds like we had just one more person jump on. So we'll maybe give it another minute and see if some other people join us.
I'd say it's a good thing you're recording this, Sandra, just because of, boy, if anybody has, well, when I grew up on livestock farm, and you guys probably did too, what I remember of days like this is basically an endless number of mornings where I had to break ice in some cattle tank someplace. So it wasn't far, and that wasn't far from where you're at, up in near Geneva, Nebraska, in that area. So, man, those are the things that, quote, build character in your life.
Exactly. And we grew up raising sheep and hogs, but we still had to break ice. We thought we were really uptown when I was growing up, when my dad put in one of those heated waterers. We just thought we were pretty cool then. And I know that was a long time ago, and everybody has that now, but yes, we just thought we were pretty cool then. Okay, yep. I think we're going to go on and get started here. Again, welcome to our grain marketing virtual Outlook strategies, and we hope that we provide you with some information to maybe help make some decisions in 2021. Okay, and we'll get my slides to advance here. Maybe we'll do it that way. Oh. Well, it was advancing before.
It could be when you shared the screen with me, I may have messed that up.
Oh, I don't think so, but usually it would have been sharing this. I thought it would be this one or this one. Oh, there we go. Okay, great. Okay. It takes a team, as you know, to make this happen. So I am glad to work with some other agents close here. My name is Sandra Wick. I am the crop production agent with the Post Rock Extension District. And I am now doing livestock as well, because it's been a while since we've had a livestock agent. So I'm glad to do that and provide you that information as well. We also have with us Rebecca Zach, and she is the crop production agent with the River Valley Extension District. So if you have any questions or need further information, don't hesitate to give either one of us a call at any of our offices. My Post Rock district is up in north central Kansas, and it covers Osborne, Smith, Jewel, Lincoln, and Mitchell. And I'll have Rebecca tell what counties that she involves with.
Yeah, so River Valley covers Clay County, Cloud, Washington, and Republic. So right next to Sandra.
Okay, right east. So we cover a pretty large area here. Just us two alone cover a nine county area. So that's pretty big as well. Okay, I'll let Rebecca tell you about asking questions.
Yeah, so if you see, if you have any questions during this meeting, we ask that you click the chat box below. There's kind of a little picture there, and you can type in your questions onto the side there, and we'll be watching that. And if you want, you can also email us your questions, and our emails are right there. We'll be checking both throughout this meeting, and I think at the end, we'll have a little bit more time to go through some more questions.
Okay.
And for our speaker today, we have Dan O'Brien. He's the Northwest Regional Ag Economist. Dan?
Oh, okay, sure. I don't think I recognize that guy. That was a decade or so ago, but I'm glad you put the picture up. Thank you.
I'll stop sharing here, but Dan has been out in the Northwest area for several years, about as many as I have been in Smith County. He was an ag economist, and then he kind of shifted and went more administration, and then he went back and joined the ranks of an ag economist again. So we are so glad to have him. He is actually the grains marketing expert guru for the state of Kansas. So if you get onto KKSU, he has a radio program, I believe every Friday. Is that correct, Dan?
Yeah, yes, with Eric Atkinson, 10 a.m., but 10:15.
Okay, so without any further ado, I'm going to stop sharing. So Dan, if you want to share your slides, and Rebecca can start. There we go.
Yep.
Okay. All right. And also, I believe there's that you had let's see, I need to make sure I know what you're looking at. So do you see the weekly grain market review? Is that what you're seeing right now?
Yep.
Okay. And you probably have this side thing. Okay, I think that's not bad. I'm going to go another route though. Just a second, stop share on that one and make sure I get the right thing up here.
Okay.
We'll eventually be back on that, but I want to get on something else. Okay, let's see. Okay, just a minute. Hold on a minute. Okay. Okay, now I come back in. Okay, so get out of that, come back. There we go. Okay. Yeah. First of all, let's take a look at, do you see the grain markets? Is that what you're seeing now? DTN grains? Is that what you screen up? So we'll start out and take a look at that. I think just
Dan, you may want to shift your camera down a little bit because we can just see barely the top of your head.
Okay. Oh yeah, I see that now. Okay.
There you go.
There's a lot that can be deduced just by looking at the prices that we have right now in the futures. When you see the corn, we'll take a look first here at corn futures. Of course, and this is 10 minutes ago. I've gotten this off of DTN grains. You can see it's pardon me, a 10-minute delay on prices. And you can see as I get a little bit bigger, the corn prices. You're looking at the March trading at $5.40 and change, and then you see a decline into the May contract, into the July contract. Those declines aren't that much, and seasonally, you're running from March into May into spring planting, and again. Spring planting anymore is a mid-April affair. Is when we start. It used to be early May. Some start even earlier, at least in Kansas. And so you are seeing sideways a little bit lower from March to May and also into July. But then you start to see a sizable drop off into September as we'll have gotten through the summer by that time. We'll be looking at USDA reports, actually the first in the field USDA report comes in September now. There's an August report, but it's based on satellite data, farmer surveys. But the first time the USDA actually gets out in the field to measure something happens is in September, on September 1. And then you see the D's contract at 452. What's been standing out to me for a good long time now has been that the market basically expects well, two things that you see that from the March contract at 540 down to the to that D's contract at now 453 traded as changed as we looked. You've got in essence about an 80. It looks to me like about an 87-cent drop from where it's at now at the March contract down to there. So the expectation is of the market that that we'll plant a crop. We won't have a drought this year. And with that, we'll end up and see prices dropping from current levels down into harvest. So that's a big deal. And that and as we talk about new crop marketing strategies, so you see that the market is giving its expectation that prices will be going lower from where they are now. You also see in that differential from just looking at corns, what we're focusing on, you see that the market isn't really giving us any carry into spring or into coming months. It's basically it's in a hard demand pull situation right now, saying it wants grain. Now, in cases like that, the market, I'm sure that a number of you are experienced market watchers, and you don't need me to tell you that the futures are showing what it expects right now. But if new news came into the market, what would happen is that March would just jump higher, and you'd probably still have this decline going on out into the future. So volatility in the market really gets expressed in that first contract. So if you have old crop corn, it sure puts you under the gun. On the one hand, you've got prices that cash prices with a break even or better basis, and I have those here that we'll show you in just a minute that are wonderful, the best cash prices we've seen basically since about 2013-14, and that was because of the drought that happened in 2012 and the year afterwards in 2013, where prices were still high, but they were falling off. So we have the best cash prices that we've seen in a good long time. And Sandra, Rebecca, you all are familiar with our cost of production budgets. We're looking at break evens, full cost break evens, covering everything, 360. 380, something like that. So these are prices at which you can't lose, really, as you look at how you would manage a farm operation. And so if a person is still holding on to grain, and I guess my own thoughts are, I would look at this as sort of a I would tend to sell grain, sell cash grain to have a a 10, 20, 40, 10, 20, 30% profit on it. And if we are still wondering about what could happen in coming months, and prices could go up. We still are dealing with strong demand from China and our own weather issues that could come into play. We're watching South America too. I would tend to keep a portion of grain unsold, but I think I would start to divide up what I have left, start to sell over a period of time here, and just realize that this market, what you see here, is expressing the typical seasonality in the market. Anymore, in the last several years, we've seen cash grain prices hold up pretty well, basically move higher from February into March, April, May, hold up decently, hold on into early June. But and then if crops coming on well, we have no risks, then we're vulnerable, because we've seen it in recent years, to that long, slow slide down into harvest. So So what you see here in this price differential from basically 541 to 539 is a sideways market now into spring. Market that's saying, oh gosh, we're pretty high. We're not sure how much more run we quote get. And then some worries about what will sustain itself in terms of prices as you head into July, September, and then down into December. So that is as it is. Now, what we see there for corn, going to shift over here. Rebecca, Sandra, you saw that shift. Sometimes those screens freeze. Did you see that? I'm focusing on soybeans. Can you see that okay? Okay.
I'm still seeing that same sheet, Dan.
Yeah, still saying same sheet, but I'm moving around on the sheet, right?
Okay, yep.
Okay, got it. Okay. So take a look at soybeans. Again, and we're just getting right to the cutting edge of what the futures are doing. Now the cash has some different things going on that are consistent, but what we're seeing here for corn, what we saw for corn in terms of about an 87-90 cent drop from the current contract into December, you see that all that much more for soybeans. There's a March contract trading at 1370. And again, still declines from March to May, futures contract to the July. And then from July, you start to decline in September, into August, September. And there's November. So November soybeans are almost, well, I think it's $1.94 below the current upfront contract. And so what we said about anticipation of higher corn acreage coming in and bringing more supplies, causing prices to be lower for corn, we really see that for soybeans. So a $2 drop in reflecting the expectations of traders it's pretty hard to hide from. So when you look at both of these, it drives you to at least consider what you might do for I guess protecting yourself on lower prices. Now I'm saying that boldly without one kernel planted. And that's the issue that so often happens. Here we have some price opportunities right now, a lot of it driven by, well, these high prices, again, a five figure in front of corn and a 13 in front of soybeans are caused by combination of two things. The primary deal, strong export demand by China. They're rebuilding their swine and poultry herds, have their stocks get down low. They at this point seem almost insatiable in terms of their buying demand. But how can you trust that will just continue on and on? Well, obviously these markets are thinking that they're insatiable now, but that with the drops they're showing, they're anticipating that it won't last forever, or not even all the way through this year. Be pretty strong, still of strength, but clearly the bloom on these markets is what we're seeing right now. Want to roll on down here and take a look at wheat. I'm going to you see this wheat chart here. I think I could make that just a little bit bigger for you. There you go. All right. There for hard red electronic hard red winter wheat. Basically now we don't have open outcry bids or a trading pit like we used to have. And the one in Kansas City closed. Got the contract was sold to Chicago, and now they closed their pit for these ag commodities. It's all traded electronically on computers. But there you see. If in case you haven't been watching the wheat market and you're thinking that can't be wheat, that must be something, maybe that's soybeans or something. No, it has a 6 in front of it. So just a tremendous wheat prices as well. Again, March at 620, but note as we saw these contracts for corn and soybeans dropping off, we've got the wheat complex going pretty much sideways. In fact, it's climbing all the way through, and we have to look at today as to what the factors are that are driving it higher. Could be drought, could here or abroad, our own issues, or a major buy in wheat. one thing that is occurring in the Kansas wheat market, and I I think in north central Kansas, in your River Valley and Post Rock District areas, you may not see as much of it, but out to the west, particularly in southwest Kansas, we're seeing a lot of wheat feeding. And why? Well, by the time you as you look up at that corn contract price, you know, with high price corn coming in, and you come over here and look at wheat prices, and look at the basis issues involved in Garden City, in Colby, Scott City, places like that. You've got the cash wheat price just barely above the cash corn price in those areas. And with buyers of corn just hyper aggressive in trying to secure supplies, in a tight market, basically trying to, if you're an ethanol plant or a livestock feeder, you're out there very aggressively trying to tie in what you need to keep your plant or your feedlot going before the export market comes in and steals it all away. That would be their view. So with tightness of supplies out in western Kansas, we're for corn, we're seeing a lot of wheat feeding happen. And where would that happen? Well, in our neighborhood, we have the feedlots to pull that off, and be ourselves, Oklahoma Panhandle, and Texas, down in Texas Panhandle, and parts of Texas as well. So it hard red winter wheat exports are okay. They're not tremendous. So what's holding this market up? Well, we're having okay exports and probably a lot of demand pull at the local area for feeding wheat out in western Kansas because of what's happening in the corn market. So just wanted to show you that. Now I'm going to get out of this and hop over into our handout that I'd sent to you guys earlier on. In theory, that's the plan anyway. There we go. Okay, I need to get this a little smaller, I can tell. Quite a bit smaller. There we go. Somewhere in the middle. There we go. Okay, yeah, let's do this a little bit, about 115. There we go. I hope you all have this. I have, again, what you see here is kind of an iteration of what we put together each week in preparation for that radio program that we do at KSU Ag Today. And that's a pretty important thing for us as far as presence and consistently talking with people. But anyway, here you have.
Can you make that full screen? Because we can see the top of your thing and we can see exporting the PDF. I don't know if you can make it full screen.
Let's see if we can do that. Okay, here. I'm in the PDF side of the world. Let's see. I'm going to, just a second, let me hop out of this. I'll bring it up in Word, and I think I can more easily knock that top out. So hang with me just a second.
Okay.
Okay, let's do that in Word. Word has a few more errata things in it, but let's see. Okay, and then with this, I can knock that screen. Okay, auto hide. Okay, let's come back in. Isn't technology just a wonderful thing? It really is. Okay, let's see. Okay, I'm pretty sure that this is it. Okay, can you see that better?
Yes, that's better.
Okay, so in what we sent you, again, I put this together to basically try to inform myself as to what's going on with these traders. And this is a very number intensive deal, but what's important is the data behind this thing. You'll note that when you look at for corn futures, and you wonder, well, what really matters? What contracts are they really following? Well, if you look at the volume of trade, that was the volume of trade on a particular day. But you look at the open interest, that's how much grain is held in positions. So it's no small amount when you think in terms of how all the traders, buyers, sellers, everybody in the March contract hold about 2.1 billion bushels worth of contracts of grain. What's even more impressive to me is that is how much they hold in May, about 2.9, and then in July 1.8. And you'll note we spent a fair amount of time talking about the December contract. That's at only 1.6. So I think you've got, when we wonder about how much how liquid these markets are, there's a lot of bushels involved, and it's ethanol plants, it's elevators, livestock feeders, exporters, people from other countries that are buyers. They all try to hedge their risk in there, and you just have outright flat out speculators involved too. But so it's pretty interesting to see that. So there's the issues we talked about for corn. There's issues for soybeans. You'll note again that the March contract has less bushels in it than the May. Now that wasn't the case that long ago. So for those of you that are wondering, well, why did the futures go down after that big run up here in the last few weeks? Well, they apparently, there's a lot of people in buy positions, long positions, that wanted to shift their position over to March. So if they were long in their positions, they had to sell those positions to get out, then to buy the May. So, that type of back and forth explains some of just these things to us, which are inexplicable. Well, how come it went down 10 cents today? Well, these people are getting out of their contracts and putting into another contract. So with that, I wouldn't be psychologically stressed by the 5 and 10 cent moves in the futures on a daily basis. It's a lot of times it's just people moving around and trying to getting out of one contract, going into another to position themselves. So in a way, we what gets our attention is the 25 and the 30 and the 50 cent moves, or about 5 days in a row a 10 cent down. Now that would get our attention too. But so here we're in a high market. There's a whole bunch of people with a lot of bushels involved. You can see also we talked about the hard red contract closes yesterday, and again, I don't know. Most of those folks are paying attention to the May contract, and the new crop is coming there in July, but not here yet. Here's where I wanted to go. Sandra, you and I were on a corn, Kansas corn webinar last night. We were looking at the corn market, went into a whole lot of detail on, that would be relevant to that group in terms of acres and all of that. I'd like to shift the focus here more to just understanding the cash market and these relationships, because I think that's going to affect how aggressive we are in forward contracting, and how willing we are to and how willing we are to plant one crop as opposed to another. So first issue that I think people are deciding on, and this would be an issue up in your area, because I think you have a fair, probably more as you go to the east, Rebecca. You have some soybeans in that part of the world, and Sandra, I think you have some also, don't you?
Yeah.
Yeah.
Okay. So this
yes, our cropping system has pretty much changed to corn and soybeans, and they just use wheat as like a rotation crop. So we're pretty heavy soybeans and corn too.
Well, and that is a change. That's a major change. We're going to talk about what's happening with grain sorghum here in just a little bit, and you'll see. But so that may make some inroads in parts of Kansas this year. But yeah, I would agree. Corn, soybeans is so often where we're at. So anyway, you look at the corn and soybean prices. I put this together to try to span across your area, and with the idea of I'm it's impressive to see where they're at, but I want to compare them. What signals are they giving to people in terms of what to plant this year? So you see for this first comparison, you have the we're going to look at the current cash markets and what the forward contracts are saying. So because those forward contracts, even if you don't forward contract and take advantage of these, still it's worthwhile to watch to see what they're signaling. So you've got tremendous cash prices. We'll since we were going to have this meeting in Belleville, I'll kind of talk about that, and we can just do quick comparisons. Belleville corn price this morning, 501 cash corn. Again, that's at least $1.50. Well, that's at least $1 profit over full economic costs. And if you look at number I said 360, 370, it's probably $1.25, $1.30. So
Dan, can you move your slides down because we're still seeing your features on the screen?
You are? Okay. Oh, yes. Okay. I got to make sure I'm looking at the right things.
There
Okay.
you go.
Sorry about that. Thank you, Sandra.
Yep.
Anyway, so you can see the Belleville cash price of 501 for corn, $13, 1301 for soybeans. And there's a ratio there of 2.6, just dividing soybeans by corn. But that's just the current situation. So, but if generally the kind of a rule of thumb in crop production areas in the U.S. is that if we get anything over about a 2.4, 2.5 ratio of soybeans to corn, that's a profitability advantage for soybeans. So it's interesting to look at that. But what I'm interested in and what I think affects your marketing choices is to look at the new crop bids. So we went again, kind of sticking with Belleville. We had a 501 current bid for corn, a new crop bid of 408. Now that 408 still, by our numbers, at 360, 370, is still covering costs. And you know, in a regular year, if we weren't seeing 501 right now, we'd see 408 and we'd be ecstatic. You know, you have human psychology coming in, but 408 is a tremendous price to offer that. And that's Belleville. But look at those other prices around the area: Smith Center, Downs, Clay Center, Concordia, Salina. Belleville's got a great price, but it's the lowest one out of these locations that I've been looking at. You might also now that shifts around a little bit. The Belleville's soybean price really pretty good, and the Smith Center price is a little bit lower for that, but still that's 1079. Soybean break evens just depends how you look at them. Non-irrigated soybeans have a cash break even. Excuse me, irrigated soybeans and non-irrigated soybeans, the cash costs are $5, $6, $7, depending how you figure it. So but full costs with land rents involved, then you're getting up here closer to this, then you're getting into the 8-9 territory. It just depends how much. Well, if you're going on a per bushel basis, how many bushels are you spreading those fixed costs out over is the whole game there, whole issue there. But anyway, so these are great prices, ranging from 1079 to 1113. But note, every one of those is the low ratio of soybean to corn, 2.59, basically 2.6. And so everything's pretty much running around 2.6 and higher in terms of soybeans to corn. So what will we do? We'll probably plant it with this figure. I think the key issue is Sandra, is what you said. What's their rotation? Because you can't really go back. I don't think we've advised people, because of disease and weed issues, to go with back-to-back soybeans. So to some degree, our rotations will kind of mitigate our response if we're really gung-ho on soybeans. So that's my take. Rebecca, Sandra, have you? So here's the local cash prices, forward bids. Are you hearing anything contrary to this, or does this confirm what you've been hearing from producers in your region and talking about what crops they might plant this year?
Yeah, that looks pretty close in my opinion. You need to scoot the slide up again because you're on the bottom.
Okay.
There
Like
you
that?
go.
Right.
There you go.
Okay. So let's move on. We'll take a look at wheat. We're going to save the corn versus grain sorghum situation to the end. Now, again, if this meeting was aiming at an audience in Garden City, this would be an amazing, amazing and heated, not heated, but a really enhanced discussion. There you have the Belleville corn bid of 501 again, Belleville wheat price of 539, ratio of 118, and note you're looking at 592 to 612 bids. The 612 bid being there in Salina. And all those ratios about 1.7. So really not a lot of evidence in your area of wheat feeding, unless you have a feeder and they cannot get corn supplies. You know, and if they're kind of standing out there in more of an isolated location and there aren't other feeders around them, they might be able to get wheat to pull into this for less than their colleagues down in Southwest Kansas, where there's a feeder every so many miles. So you do see that. I just put up here the bid between new crop wheat and new crop corn. And why even do that? Well, in some years, if we're really gung-ho about corn markets, we'll, you know, we can tear up wheat and put corn in there. Well, I don't know that many people are going to be tearing up wheat at 592 per bushel. We tend to do that when it's 3 or 325 at the loan rate. But just to look at that, the wheat prices in your part of the world, are basically 45% above corn. And unless you got just drought and then you got stands falling apart, you wouldn't think you'd see a lot of wheat being torn up and going to corn. Around Kansas, Sandra and Rebecca, there was a time, and I think there still are pockets of north central Kansas where you see quite a bit of grain sorghum. It may probably not in that Smith County area, Sandra, I wouldn't bet, but Concordia, some other places, maybe some more. So I moved this up. Can you see it okay?
Yep, it looks good. And I think maybe sorghum is maybe coming back just a little bit because they like to, for the cattle that they put on the stalks, and they really like the Milo stock. So, if the prices keep going up, I know west, there's quite a bit of Milo, and even south of here, there's more Milo as well. So it may be coming back just because of the cattle.
Well, we've had meetings just like we had planned that we got froze out on here on Tuesday, your area and in places to the south and running from basically a swath from south from west central Kansas up to Russell. Those meetings, we were asking every one of them to focus on grain sorghum because that was where local interest was. So we'll probably, if that's any barometer, then we're looking at more sorghum. And why? Well, look at these prices. Cash prices for sorghum at Belleville, $661 for a cash sorghum price, current price, versus the 501 for corn. So 32% higher. And and given the cost of production for sorghum, as we've looked at it, in past years, it was around 310 per bushel. Now, when I talk about cost of production, what we are seeing also, though, as sorghum and corn acres are probably going to both go up, we're seeing fertilizer prices move higher, seed prices moving higher, chemical prices. So we're going to, we're already seeing inflation in cost of production to some degree. So probably the wise managers are looking at this, but they're also talking to their farm input suppliers and locking up supplies so that they don't get caught short on the backside in terms of having what they need to get crops in. So anyway, here you got, yeah. So you you see what's happening now. Again, 661, 650, 671 in Salina, 689, almost $7 per bushel. And that's driven by Chinese export demand. There's not even a grain sorghum bid at Kansas ethanol plants that's publicly reported. So exports and anticipation exports will keep going. Very strong, but very strong demand driven by one country. So interesting to see. But then you have new crops. So if I think when people are looking at acreage choices for sorghum, they're probably really looking at the current cash prices, but I would hope that they'd also look at forward contract bids. The forward contract bids are also showing the same, about the same percent higher, maybe just a hair less. There's the Belleville forward contract bid at 503. That's 503 for grain sorghum fall 2021, as opposed to 408 for corn at the same location. And actually, again, Smith Center 493 bid. I mean, unbelievably good bid relative to 325, 340 cost of production. So real profitability. You just have to go through the sleepless nights and making sure you get a crop there. So there you have that to consider. There's some other things happening in the broader markets, and I have this there just because it's good to remember that what the Dow Jones does, what the dollar does, what the oil market does, if something happens that would come in and shake the confidence of financial markets, of the stock market, then the commodities, all the commodities and the ag commodities get affected as well. And when have we seen something like this? Well, 2008. If most of you remember that, when that time when the financial markets struggled and the ag markets followed suit. So when something happens to shake the confidence of the market, people tend to get out of any speculative position and get cash in their hands. And that affects the commodities too. So so we're talking about exports to China and tremendous cash prices. One reason also to look at marketing, even, we're not talking a lot about options today, but to look at some price protection is that I don't think you can say right now that we have less geopolitical international financial risk than we had before. Probably the thing that we're wondering on is inflation, which is sort of the inverse of that US dollar chart right there. So interesting. We'll move on. And yeah, I just wanted to show you here quickly. And I know, Sandra, we're done at 1. So let me hit some things pretty quick, okay?
Yeah, I was going to tell you, you have about 20 minutes probably.
Okay. Well,
15, 20 minutes.
I'll be done with what I'm saying by 1 and leave a little time for. Okay. So note one big worry in the corn market is that higher corn prices. What are we going to shut down ethanol plants or will we have to because we're losing money on the plants with high corn prices? Well, so far when you look down here, is out of Iowa. This is a daily USDA daily ethanol plant report. And you can see the Kansas prices at the plants. This is about the first time I've looked at it that we don't have the highest U.S. top end of our cash bid range. Today we're a little bit behind a location or two, at least one in Indiana, but 559.5 bid at the plants. So tremendous, and you see you can see and that's the top end of our range there. Basis 25 over there. So you can see that distillers grain prices had ran up, doing decently. Iowa corn prices running pretty good. Ethanol prices about $1.50. Come over here. Can you see my cursor on your screen as I point that around?
Yes, can.
Okay,
Yes.
good. That helps a bunch. So we do have ethanol prices having come up, average 148. It wasn't that long. We were hoping that thing would stay above $1. So I guess given that 5 or 6 5 some billion bushels of corn out of the 13, 14 that we grow goes to ethanol. It's pretty important that those plants keep going. And so far, ethanol market has supported those plants being open. Haven't heard much talk of them closing. And you can see kind of patterns here of when you see this was COVID-19 and the close down of the economy. So we've recovered. We've recovered in terms of ethanol production and corn usage, almost up to about, well, we're still about 10-12% short of where we were before this thing hit. So it just is as it is. And you do see some issues here with the rebuilding of stocks. So a little bit of worries, but overall, they're hanging in there. Weather patterns. This is maybe our biggest. We worry more about this for wheat right now, just because it's so frontal. You'll be right in front of us. March, we're going to break dormancy, and what moisture will we have out to the west of you, where you're at? Well, in your areas, you're showing abnormally dry to moderate drought throughout your area. Worse out to the west. So any moisture that comes, they're just pleased as punch on. But still too early to declare drought yet. That's for sure. And I would say, so you look at amount of moisture around the world. One thing that's holding up has been holding up corn and soybean prices has been these dry areas down in parts of on some key production parts of South America. So just got to watch it. And their second corn crops being put in late. Some of the key areas for that's right in there where they grow that crop. And this has affected soybeans as well. And so part of that $13 soybean issue has to do with the impact of some of these scattered areas down South America. Also, the wheat market, I always have to be careful. Making sure I get the right area here. But you're over in this part of the world around the Black Sea area, there's some pretty dry areas here. And so part of our support in the wheat market has to do with, some of this business, dryness around wheat production areas in Russia, Kazakhstan, parts of Ukraine. So that's in play too. But most of the time when the wheat market responds to this, it's in August of next year. So it's dry now. They can get moisture out of it, but just interesting. Too wet in China a lot, and it's still too wet in China in parts of these areas. And you're kind of looking at where they grow a lot of crops. They talk about their northern plains in these areas. So you got some dry, some too wet, some mixed issues going on. So when all those prices we were looking at in the futures, a lot of them are predicated on how China is responding to all its animal disease problems and crop production worries. So that's pretty red and that's pretty blue, and they have issues. So let's move on beyond some of this. In the minutes I have remaining, I just wanted to show you the actual there's a lot of things that I watch on this report in terms of daily pace of exports, etc. But I want to show you the price charts. Now here for March corn, this would be the upfront contract, pretty high volume as we talked about. These were yesterday's closes. You can see we were down about 324, 326 last summer, and so just think of the psychology of that, from thinking, oh gosh, we've got a good crop coming. There's no way we'll ever see much good at all. The March corn futures at that time, that was way out there beyond December. We had no optimism, and basically we're at about 330, 330 for that contract. Well, then moisture issues started to happen, excessive floods in China, and some of our own crop production issues came here into November, and the China issues began all that much more in earnest. Got out into here, the date of a report, and the market looked like it was ready to give up, and then found out that, well, we overestimated last year's corn crop, we being USDA, and we jumped back up and have gotten up to a high about 575, and now are at 541. I showed you some of that, those contracts, how that March contract used to have more volume. Well, they sold out of that, bought into May. So some of this is just up and down, the psychology of the and the function of the market. So we're sitting at a not unprecedented level. If you basically, you have to go back to about 2013 to see, and that is when prices were falling off in latter 2013 to see prices this high. And you've got some technical things there to look at. You'll note for world and corn supply demand fundamentals, U.S. stocks to use. Note these levels: 13% stocks to use in the 15-16 marketing year, 16, 14, 15, etc. This year they're projecting 10.3, the lowest in about 7 years. And prices 430, way higher than where we've been looking at. So these things are affecting us, and you can see that for the sorghum price, corn price is at 430. The sorghum price projected to be 480. So the reason for those prices of sorghum being higher in our area than corn has to do with all that's going on with China. So I've got some things there to look at. Just quickly, if you look at the next, if you're a close market watcher, you have old crop grain, you wonder what information is coming at the market next. Probably March 31st is a big report. USDA comes out with a prospective plantings report and a grain stocks report. So before, after that day is likely to be a time of real volatility in the market. That stocks report will tell us how much feeding of corn and wheat there's been. So both those markets could be affected in a big way. And the USDA will do their surveys. They'll come out and they'll say they'll give their estimates of what farmers have told them they're going to do for planting. So look at a 2% and a 4% increase. And to me, using average yields, went up here in all of this, you've got it in front of you. Basically, 2% increase, supply demand numbers with usage pretty much unchanged. You get about a 420 price, about where we're at now. And but if we get a 4% and we start to get stocks inching up closer to 2 billion bushels, then as I fit those lines and the models of where we'd be at about 370. So that's a 50-cent swing. And so for corn marketing, that just behooves us to look at those forward contract prices and see what we have. And I just, because of the stakes are, if we get a large crop, if we get sizable acres, no crop problems this year, then the 450 futures we're seeing right now probably will erode down to something below $4. And with basis bids as they are, you'd be looking at 350, 360, 370. So I'm not trying to scare you into marketing, but I think these risks are out there. So let's kind of move on. Would say this corn seasonal price index, when you look at the futures and use basis levels, I guess I'm an economist. They pay me to worry and to look at what could happen on the bad side. But if you look at where these futures are at, when we've talked about it, they're basically pointing to pretty high prices now, and what the futures are showing is basically prices holding up pretty decently through June, and then being at risk to falling off pretty readily off into harvest. So we've got a window here to be watchful from now through June, and so I'd be. It's a shame we didn't have our meeting, because that's what we were going to talk about in earnest, to take advantage of seasonal price trends that are out there. Okay, some other things here. I think we're short on time, but those are CFTC positions, and I'd answer questions on that later. Wheat market, we'll focus on this pattern here. The March futures, they were down at about 430 back at about the same time. Note note these markets tend to move together, and you'll see this on this. So their lows are about all the same time, and so wheat also followed suit, jumped up to about about 665, 660, something like that, have eroded down to now down to about 611. So off their highs, but way higher than where they'd been for most of this time frame. And again, these are highs from back X number of years ago that we're making. And so wheat sales, wheat export sales, just so. I think hard red winter wheat exports, what we're seeing in our areas, if you and I crunch through those numbers, et cetera, has a lot to do, I think, with wheat feeding happening and crowding out some hard wheat exports, because we've have even though relative to corn there's some weakness, still you're seeing pretty strong wheat prices. Move on, and just want to show. So here's kind of what the USDA is projecting. Really, kind of a milk toast sort of a projection. $5. Well, that's sort of in between where we'd been. If anything, if I really believed at 516 that was the right price, and stocks to use for 53%, and if I really believed that was right, or even believed this was right, for 49% stocks to use and 458, then at 39% stocks to use, this price would be too low. That's just the way. If these two are right, and we've dropped stocks appreciably by 10-15%, then the wheat price ought to be higher. So thought-provoking. Probably the reason, because of that we are seeing high wheat prices now, but it's the last 3 months of the marketing year, and so much was front loaded on lower prices that you got that. And here's what the futures are showing. Again, we've had from June, July, we spent all this time lower prices, ran up into January, sideways into February, and they're basically showing sideways. That's what they're expecting. And we'll look at soybeans. Here's soybean prices. Now, at that time when everything was low for corn and for wheat, about in here, we had a low, but wheat's low actually happened earlier, back in late April or early May. But we were down at this time, just to be about equal with our others that we're looking at, about 875, ran up to just about, well, it was $14, 1401, 1402, as I recall. Have fallen off since then to 1367. But note that the thing on this is 81 million bushels of exports, and we only need 15 for the rest of this marketing year to get there. What'll happen is the South American soybean crop will come, and this will fall off dramatically. But even with that, if you doubled this, we're still way more than double. And you could triple that, and we're, in terms of the weekly rate, and we're still ahead of that. So China aggressively coming after U.S. soybeans. There'll be a day when that falls off. When that happens, then I would think that this price probably erodes, but it's not here yet. And so we're I have 1 minute, Sandra. We're at the place, the 2%, 2.6% stocks use is the low. We're tied to the lowest we ever had. At that time, when we were at that point, we were coming off the drought, the 2012, we had $13 soybeans. And now we're back to there. And again, relative to where this is at, this is a pretty good price. So we're in the range of where this thing can go. And we're down at, as Sandra, you and I, and Rebecca, as we've talked about this, we're down to getting brooms out and sweeping around the edges of the bins. What's left just to sell is really kind of the issue. Seasonal index, but you can see this thing run up January, February, sideways. The futures are saying it basically expecting it to hold up and then decline off into fall. So that's this same chart, this figure 2B for soybeans, is the same chart we saw for wheat, and also especially for corn. Expectations that the current situation that we're looking at will bring stronger acres that will hold up for a while, and then once we kind of resolve the uncertainty of production out in after we get our crops planted, then if there's no problems emerging, then prices will be going down. And I'll make this statement, then I'll be quiet. The in a way, this would be a good year to have a good set of crops, just to make sure our domestic industries don't get damaged by even higher by really, really high input prices. You know, you start to hurt soybean crush, hurt ethanol plants, livestock feeders, etc., or even price ourselves out of the export markets if we jump $2 or $3 more on these things. So, but and that all happens very likely if we have a regular crop. But just think of the situation this year if we don't. You know, what happens if we don't? Wow, what volatility, and it'd be a real Donnybrook of a deal. So Sandra, Rebecca, that's what I've got to say. Can I take any questions?
Okay, yeah, don't be bashful. We don't have very many on, so if you would just want to unmute yourself and turn your camera on and ask questions. I do have one question, Dan. As you presented that information, there's a pretty big opportunity to do some forward contracting here on maybe soybeans and corn. Is there kind of a general rule? How do they know how much to forward contract? Because that's always the biggest question.
Yep. Well, I think that the first place you probably look at your crop insurance revenue coverage, and look at the APH yields that you're looking at. And again, we can range from typically in the range of 65, 75, 65, 70, 75, 80% APH. APH is actual production history. So you have that. If you have 100, yeah. Do I need to knock that out, or did you do that already? Stop that share. Thank you very much.
Yeah, I already did.
Yeah, thank you. Anyway, so we look at the APH yields, and already you're kind of discounting it, and that comes. You're not insuring 100% of your actual production. You're insuring 75% of it or 70% of it. So you look at what those bushels are on a field unit, insurance unit, and then ask yourself early on what percentage of that am I willing to put at risk? You know, a lot of times people will look at that unless they're really, really comfortable with accepting risk. They go up to 10%, 20% pretty readily. Yeah, I'm pretty confident I'll get that. 30, well, yeah. 40, well, yeah. 50, well, I don't know. It could get dry. Well, but and I think what happens is the more you get aggressive and proactive in forward pricing, the more you're inclined to probably buy hail insurance or to make sure that your crop insurance is coming in. And the issue, I think for sorghum, we've got an issue in that with the strong positive basis bids, the bushels you get paid back, i.e. you've got hailed out, got a crop, they're going to be paid at 100% of the planting price. And that's the December average for the month of February. And it's probably going to be 450. You know, that's where it's hanging out. So if, and the forward contract bids, as we looked at them, you know, they're about in that area. So if we got caught short in production and had to go back in from the elevators or someplace to buy bushels or pay them off, yeah, you know, 450. They give me 450 for what I'm short. I go buy 425. Well, whatever. The risk is if these tremendously positive basis bids of $1 over, if they continue into harvest, and then if you get hailed out or whatever happens, you're getting paid at the futures price, but you'd have to go back into the market and buy bushels at $1 something over. So for as great as those prices are, what it does, it makes you probably a little more conservative on sorghum for forward pricing, just because we're not anticipating that. But the market's saying that that's going away, but it's not gone away yet. And so Rebecca, Sandra, that's my only caveat on aggressive forward pricing. If you go the grain sorghum route, because if you have to buy replacement bushels at sky high basis levels, then you're, it takes 1.5 bushels or 1.3 to replace every bushel you'd be short after your payment.
Right. Right. But they just need to maybe think about it this year if they haven't and look more into it with the predictions of prices that you're talking about.
These, well, that's for sorghum. I think for the other crops, I think, it's, we don't have forward contract basis bids that are putting us at or the possibility of basis that putting us that much at risk.
Yeah.
And some of your people have irrigation. If you have irrigation, you're less worried about drought. Then you just buy a lot of hail insurance. So anyway, under irrigation, people are probably a little more proactive, a little more aggressive, just because they're isolating off one element of risk.
Exactly. Okay, so you all have any more questions? Because we don't want to keep you any longer, because I know you have things to do outside, especially if you're calving, to go check your cow herd. So I'm going to share one last screen here. And Rebecca has put up there for you in the chat. As you know, if you're at Rebecca or any of my meetings, we really enjoy hearing from you with an evaluation. This is very short. Let me tell you, it won't take very long at all. There is a link right there in the chat. You just simply click on it and you can simply fill that out in probably less than 5 minutes. So we do appreciate you participating in our webinar, but that evaluation will help us determine some other virtual programming that we would have too. Our websites are up there. So there's the Postrock, www.postrock.ksu.edu, and River Valley, www.rivervalley.ksu.edu. So if you have any questions, don't hesitate to give us a call. So again, thank you and stay warm.
Thanks for having me, guys. Appreciate it. If you get evaluations back, I'd value seeing them too. That's good to get feedback on how you can do better.
Okay, that's great.